And tonight, Market Moves 2021, we've got a very special guest, Geoff Howie from SGX, joining us tonight. But before that, some formalities, and let's get into it. Disclaimer, just so you guys know, that's what we do. And a short video, so guys, sit back and enjoy. Oh, that wasn't supposed to happen. There we go. Oh, okay. All right, so that was the video, and for you guys to participate in this competition, simply scan the QR code that's on your screen now, and you could drive away with a Tesla at the end of the year. Okay, so again, good Wednesday evening, everyone, and welcome to Driven to Learn. Today's session is brought to you by CGS-CIMB in partnership with Singapore Exchange. And the topic is investing takeaways amidst the recovery from COVID-19. And we have with us tonight, Geoff Howie from the Singapore Exchange. He's a market strategist with 25 years of experience. That's a quarter of a century, Geoff. And he's been here 12 and a half years, our resident Aussie. He hails from Queensland in Australia. And here's a fun fact. Geoff and I are actually alumni from the University of Queensland. And we both took the same course. Bachelor of Economics. We weren't classmates. I think there's probably a couple of years between us when we were at college. And Geoff has been around the block, and he also served as the Treasury Advisor to the leader of the Queensland Liberal Party. There you go, some political leanings as well. So yeah, Geoff's going to talk to us about recovery. And I thought, Geoff, being a resident Aussie, he should start with how things are back home down under. And then we can, mosey on down to Singapore and talk about how we're doing over here and what we should look out for as we come out of this pandemic. So Geoff, over to you.
Thanks so much, Gary. I'm going to just quickly share the screen, but as I do, you're right. Australia is I guess starting to open up in Sydney, then Perth and WA still closed, and Brisbane still closes if they have one or two cases. So a lot of it starting having a lot of ramifications for the smaller economies, particularly the consumer-facing ones. For the industrial side of it, the manufacturing side of it, of course, like we know around our region, you can survive just by adopting, some safe distancing measures and so forth. You can continue your business, particularly if it's more leveraged to global trade, which is going to well outpace consumer-driven growth this year. So yeah, I think Australia, unfortunately, as you mentioned, we come from the same university, and I think they were banking on our university of Queensland, actually coming up with their own vaccine. And for that reason, they're a little bit slow. It seemed to have been a little bit slow in the ordering of the vaccines, and nonetheless, they are catching up pretty quickly now. But I still don't know when I'll get to see my folks for a while. I think we've missed, in the family, we've missed 3 funerals now over the past 18 months that we otherwise would have gone to. So it's it's still tough, but we'll get there. But anyway, I should I mean, the reason we're here is to focus on the Singapore stock market. As Gary said, I'm the SGX market strategist, and I want to take the next 45 minutes or so to run through the current market drivers of our Singapore stocks. Much of what we talk about tonight is designed to be purely informative, and many recent observations will be, I guess, on the moves within the stock market. It's not providing investment advice. Rather, what we're doing is looking at it, I guess, looking at what's happening in the market through the lens of many of the listed companies. Okay, so let's start. In the year to date, our benchmark, the Straits Times Index, also commonly referred to as the STI, has generated a 8.5% price gain, and the reinvested dividends have boosted that total return to 11.5%. Now that takes the near 10-year annualized total return of this 30 stock index to 5%. That's 5% every year for the last 10 years on average. So of all the regional and the global indices, the index that the STI is most correlated to is the FTSE ASEAN All Share Index, which kind of makes sense. And that's represented in the represented by the green line here on the top right. So obviously we have these solid economic foundations, and I guess you have this regional bundling that comes with institutional portfolio flows. And for that reason, the STI and the FTSE ASEAN All Share Index, they have this simple 93% correlation in daily close prices for the past 3 years. And I should also add that as many as 100 stocks in Singapore generate more than 10% of their revenue in Malaysia, while another 50 stocks in Singapore generate more than 10% of their revenue in Indonesia. So Singapore stocks, they make up around 27%. Let's say it's around 25, but I think it's more like 27% now of the weightage of the FTSE ASEAN All Share Index, which reinforces that correlation. And the regional index maintains a market value of $2 trillion US, similar to the combined ASEAN GDP. So that's, I guess, just from the outset, I'm just trying to set the stage and let you know and share with you, which index really has the most directional correlation and day-to-day, I guess, correlation with our market, and that all makes sense. Over the 10 years, Singapore GDP, though, on a current price basis, it's averaged around 3.8% annualized gains, while the Singapore Government Bond Index has generated 2.2% annualized returns, and the Urban Redevelopment Authority Property Price Index, residential index, that is, has generated annualized gains of 1.1%, obviously on the back of the ongoing macro-prudential cooling measures to the local housing market that we've seen since 2011. Now that property price index 1.1% annualized gain does not include rental income. So with that 1.1% annualized gain, it is similar to the 1.4% annualized gain of the STI when you exclude the impact of dividends, which takes that annualized return of the STI up to 5%. But I think it's worth noting that by comparison, the returns of the Singapore stock and housing benchmark, they have been relatively muted to the world's largest, economy by comparison. The Dow Jones Industrial Average, it saw 3 times the annualized total returns of the STI over the 10 years. And the S&P Core Shiller, It's the S&P Core Logic Case-Shiller US National Home Price Index saw 6 times the annualized gains of the property price index here in Singapore over the same period. Now, that did not mean trading opportunities were not there for investors that were prepared to look within and beyond the benchmark. Of the current 30 STI stocks that have a 10-year trading history, Mapletree Industrial Trust, Venture Corporation, and Mapletree Logistics Trust all outpaced the Dow Jones Industrial Average with 16% annualized total returns over that 10 years, with the least performing stock of the current STI stocks, Dairy Farm International, with a 6% annualized decline in total return over the 10 years. More recently, there are 7 REITs that make up 14% of the STI weightage, while the 3 banks make up more than 40% of the STI. And they have also been impacted by global sector trends this year. Then that has provided a lot of rotation opportunities for investors. For instance, banks were amongst the strongest sectors of the first quarter of 2021 on the back of resilient investment activity across the globe and a generally steeper yield curve, which is shown in the lower left chart. That support and that basically that generally steeper yield curve, that light blue dotted line for the first half of the year, supports banks that obviously borrow short and of course lend long. Now, since the 8th of June, those 10-year yields, when those 10-year yields ended the New York session at a fresh 12-week low, the US yield curve has flattened from 138 basis points to 110 basis points. Now, that flatter yield curve on the back of the lower 10-year yields has coincided with rotation into global REITs, which maintain a median yield of around 4% for all the 800 REITs traded across the world. And this has seen REITs outpace the banks since the 8th of June right through to the present, with global bank indices down 1%, global REITs up 4%. And that has extended to the STI, with the 7 REITs also averaging 3% total return since the 8th of June, while the 3 banks, DBS, OCBC, and UOB, averaged a 1% decline in price. So the big moves of 2020 and early 2021 also attracted a surge of retail investor flows. And we try to illustrate that in this lower, oh, not this one, in this lower right chart here. Okay. If you look in this chart, the dark blue line represents the STI. And when you look at you can see the retail investor flows tend to swing to net retail inflows amid market weakness and swing to net retail outflows amid market gains. So inflows amidst the weakness, outflows amidst the retail gains for the retail investors. And for instance, Singapore's largest stock by market value, in addition to our most traded stock, DBS Group Holdings, it saw close to 2 billion Singapore dollars in net retail inflows for the first 3 quarters of 2020. And the volume weighted average price of the stock over those 9 months was $21.01. Then DBS Group Holdings saw net retail outflows of $1.9 billion in the subsequent 3 quarters, spanning the 4th quarter of last year right through to the 2nd quarter of this year, with a 9-month volume weighted average price of $26.42. So the VWAP price amidst the 3 quarters of the significant amount of net retail selling was 26% higher than the 3 quarters of significant net retail buying. Hence, while the STI has provided these, I guess, as I said, these modest 5% annualized returns over the past 10 years, comparable with the growth of other asset classes here in Singapore and the regional index, retail investors have taken the opportunities amid the week-to-week developments in economic growth, the progress in containing COVID, and the resulting sector trends and the big moves. And this was further demonstrated. I should make this point because our head of ETFs is also in the audience, and he, because he's really interested in following this the whole driven campaign. We can further demonstrate the the retail rotations and so forth by when you look at the STI ETFs, close to 60% of the combined inflows of the 2 STI ETFs over the past 10 years came in the space of just 10 months. And those 10 months span March through to December last year, when the VWAP of the 2 STI ETFs averaged $2.67. And those 2 ETFs are currently trading around $3.12 per unit. So as we said, lots to look, lots of evidence that investors, in terms of the flows, are very much looking beyond the benchmark. Now, a big driver of the benchmark, as we said, with their 40% weightage, is the banks, DBS, OCBC, and UOB, that make up 20% of the total market cap of all stocks listed on the Singapore Exchange in addition to 20% of the day-to-day turnover. And the three banks also make up, as we said, more than 40% of the STI. And so far this year, the three banks have averaged 21% total returns, which is closely in line with global banks, which are also up 20% in the year thus far. And as noted in the first slide, banks have been supported this year by resilient investment activity across the globe, in addition to a generally steeper yield curve in the US, which is conducive to bank operations. For the second quarter of this year, DBS, OCBC, and UOB reported combined net interest income of 5.13 billion Sing dollars. That was up 1% from 5.08 billion Sing dollars in the first quarter of this year. And for the trio, this was the highest quarter-on-quarter increase in combined net interest income since the increase in the third quarter of 2019. Growth drivers for these three banks, they include digitalization, the broadening of wealth management services, and a continued focus on supply chains and growth markets. For growth markets, DBS, OCBC, and UOB have increased their combined annual income that is segmented to Greater China from around 2 billion Sing dollars in 2010 to more than 5 billion dollars in 2020. UOB's rest of Southeast Asia franchise also grew 7% last year, which was on the back of strong growth in Indonesia and Malaysia. And DBS has also highlighted this year that the amalgamation of the LVB in India and the Securities joint venture in China will enhance its presence in both those markets. And as illustrated in the lower left chart, the combined wealth management net fee and commission income for DBS, OCBC, and UOB has almost tripled from near $700 million in the first half of 2014 to close to $2 billion in the first half of this year. In the first half of this year, combined wealth management net fee and commission income increased 21% from the second half of last year, which was the strongest sequential growth since I think it was 30% odd growth in the first half of 2017 from the second half of 2016. So wealth management was earmarked as a growth segment going into this year. And similarly, iFast Corporation also noted as a result of the group's assets under administration, its net recurring net revenue continued to grow. I think it increased something like 34% in the first half of this year. For this wealth management business across the curve, there's a report last year that Morgan Stanley and Oliver Wyman put out, and they mentioned that wealth management businesses should be doubling down on technology investments, strategically cutting costs, building differentiated product offerings, and considering inorganic opportunities as potential sub-drivers for this driver. But I should note as well, one final point on the banks is that as far as current valuations go, the average price to book ratio of the three banks is currently 1.15 times, so 15% premium to book value, with the median price to book of the top quartile of global banks pretty similar at an 11% premium to book value. And like the top quartile of global banks by market value, the average price book of DBS, OCBC, and UOB moved from an approximate 15% discount at the end of October 2020 to more than a 10% premium at present. However, for some historical context, the median and the average PB ratios of DBS, OCBC, and UOB remain well off the 40% premiums observed in April, May 2018, which followed a particularly strong year for the Singapore economy and stock market in 2017. And it reiterates the importance of economic activity on the performance of stocks, particularly financial services. So moving along, look, a key reason for the various indices and the sectors consolidating on their first half gains this year has been clear signaling from the Fed Reserve. I mean, the signaling got clearer, wasn't clear from the start, but clear signaling from the Fed Reserve in recent weeks or recent months that while the tapering of asset purchases may begin before the end of 2021, the consideration of the Delta variant and its impact on the US labor market remained a priority ahead of interest rate hikes. Now, as shown in this table represents the sectors of the 150 most traded stocks in Singapore. So the 3 banks, in addition to the 31 stocks representing the REIT sector, among those 150 stocks, and the banks, the REITs, they basically performed positive returns in both the first half and the second half this year through to yesterday's close, along with the 12 stocks that represent the technology sector that are amidst those 150 stocks. As a group, these 150 stocks, they make up 3/4 of our total market cap here in Singapore, and they make up as much as 95% of the day-to-day trading turnover of all stocks listed here. For the first half of this year, the Singapore economy, it rebounded 7.7% year on year, while the STI ranked among Asia's 3 strongest benchmarks. And all key sectors of the Singapore stock market, as you can see in this table, all 3 sectors were in the green, with a number of stocks also reporting bumper year-on-year earnings growth. But as we do see in the table, the second half of 2021, when you look at the second half of 2021, it has started on a more mixed note, which has been a global development, with the concerns of the continued growth in COVID-19 cases on decelerating sequential economic growth, reinforced by the new 4 million global cases of COVID-19 every single week over the past 10 weeks. And at basically the 7-day rolling average of, the mortality rate still hasn't gone below the 300, sorry, I've got myself tongue tied. Yeah, so the key point is that while we are seeing significant progress on the vaccine front, which we've distributed as 4 billion vaccines, set to distribute 9 billion vaccines by the end of the year, we're still reporting across the globe 4 million global cases every week. That's 4 million new global cases every single week. And that's been the case since the end of June. Okay. And that's despite the global vaccine progress. Now, these concerns since the end of June, what they've seen is the global stock market gained something like 2% over the past 11 weeks, while the Asia Pacific stocks, including the STI, have generated 1% declines. Now, since June, when you look at all the sectors and industries across the world, mining, utilities, technology, healthcare products, and basic materials have been among the stronger industries of the global stock market, while segments such as lodging, food services, leisure, airlines, and transport, they have been among the least performing industries. And this has reflected the increased focus over the past 11 weeks on the companies and the industries or the trade-related segments of the market, that's physical trade, exports, imports, trade-related segments of the markets that have been able to be fully operational in the course of the COVID-19 constraints, while possibly also seeing increased demand for their products and services. So as you see in this table that represents the Singapore market, utilities, technology, and basic materials have also been among the more defensive sectors in the second half of 2021 through to the 14th of September. While those industries with the consumer cyclical stocks, they have been among the least performing segments. So the strength of manufacturing in Singapore this year is really extended to the stock market as well, with manufacturing stocks in Singapore, they spanning multiple sectors, including industrials, technology, consumer staples, healthcare, materials, and resources. So in addition, I guess, to the outperformance of these industrial, manufacturing, trade-related focused stocks, compared to the consumer and tourism-related stocks, you can see this as well in the global REIT market. the median gain of global industrial REITs has been 5% since the end of June, compared to a median decline of 2% for the Asia retail REITs and a median decline of 5% for the global hospitality REITs. In Singapore, the strongest performers of the industrial S-REITs have noted that while the economic climate continues to be challenging, the logistics sector continues to demonstrate resilience, and the demand for industrial real estate has been underpinned by the manufacturing sector, which has been attributable to expansion of the key clusters, electronics, precision engineering, and the chemical sectors. So let's look at some of these resilient businesses amid the recent COVID-19 constrained global growth. So recent earnings reports across the world, they really have provided, I guess, insights to investors on which companies have been able to remain fully operational amid these current COVID-19 constraints. On the theme of the resilient global investment, real estate agency Propnex reported for its first half of this year, its net profit after tax grew by 115% year on year. Real estate agency APEC Realty reported 121% year-on-year increase in its first half net profit. And iFast also, back in late July, reported its net profit for the first half of this year was up 94% year-on-year. So as we said, resilient investment has been a key theme across the world. And we've also seen that, as we mentioned, Urban Redevelopment Authority Property Price Index has also been quite resilient over the last 12 to 18 months. But trade has also been a key driver of global growth and stock market activity. China-based shipbuilder Yangzijiang has been the STI's strongest stock this year. It's now secured something like 118 vessels at a contract value of $7.2 billion this year so far. And when it reported its results back in August, the company cited a Clarkson's report that stated global new shipbuilding orders in the first half of this year made a 7-year high with a total contract value of $52 billion, and that was underpinned by a huge number of orders placed for container ships, which accounted for more than half of the new shipbuilding orders in the first half of 2021. Meanwhile, there's Industrial Association Drury noted factors have turned global container shipping into a highly disrupted, undersupplied seller's market in which shipping companies can charge 4 to 10 times the normal price to move cargo. With regard to the potential business and operational impacts arising from supply chain disruptions and these soaring freight costs, Franken Group, and under the technology semiconductor section here, said with its recent returns illustrated in this slide, that back in April, it had witnessed across the board price increases of raw materials. However, certain contracts with customers had provided them leeway for the group to pass on these costs to customers if material prices increase above a certain threshold. So the group has added that maintaining close communications with their customers on their forecast has been really important, and it had planned to ensure their supply chain was in sync and they were able to mitigate any potential challenges. So I should also mention UMS Holdings noted in August that global chip demand accelerated at an unprecedented pace in the first half of the year. It cited estimates from Industrial Association CIMB, SEMI, maintaining global sales of semiconductor manufacturing equipment are forecast to surpass $100 billion in 2022, a new high after jumping 34% in 2021, as that's what SEMI currently estimate. So in the medium to longer term, the global semiconductor manufacturing equipment market is expected to continue growing at 10% from 2021 through to 2026, amid supportive trends led by various technological advancements. Now, the granularity on those technological advancements, they seem to be the utilization of artificial intelligence solutions, integration of connected devices with the whole Internet of Things. And what's important is UMS, like Franken Group, had noted in 2020 its focus on efficient supply chain management. And subsequently, UMS noted in August that the group's key geographical markets all grew substantially in the second quarter of this year. On the healthcare product front, the two household names, Raffles Medical Group and Q&M Dental, they're included here under the healthcare products, which you might think, well, what's that? I've got that one wrong. But this is because Raffles Medical Group has actively supported the Singapore government in its COVID-19 vaccination and the PCR swab test initiatives. Q&M Dental, it also noted in its second quarter results when its revenue doubled year on year. That was mainly on the back of higher revenue in the dental outlets and the low base, but as well as significant revenue contributions from COVID-19 testing from the group's COVID-19 medical laboratory business. So the three stocks, they averaged 44% total returns in the first half of this year, the medical providers, and 6% returns so far for this quarter. Raffles Medical reported in late July, I think it was 42% year-on-year growth in its first half revenue. And on 13th of August, Q&M Dental reported total revenue for its first half was up 73%, while Tianjin Zhongxin Pharmaceutical reported on the 13th of August an 11% year-on-year increase, with its net profit basically up 43% year-on-year. It was interesting too, because reforms have been a focus throughout the year in 2021 in China. But among many of the reforms that have been introduced this year, one of the first for the year was the State Council of China issuing several policies and measures on accelerating the characteristic development of traditional Chinese medicine, with obviously the endemic in process. So these I guess, these are just a few examples of stocks that have outpaced the benchmarks over the past 10 weeks, mostly. And based on, I guess, the global themes of resilient investing, which has been seen in the Singapore property market, in addition to global demand for electronics and increased demand for healthcare products on the back of the COVID-19 developments. Again, I'm going to mention these are not recommendations, but rather an opportunity to provide these educative examples of the relevance and the span of our stock market. This slide is an interesting one too, because this has been a very important part of our market. Gains in the commodity prices this year have been, and these are all from the 150 stocks, I should mention. Gains in the commodity prices this year, they've been largely driven by the COVID-19 constrained supplies. And the other drivers, they've included industrial sectors, as we said, recovering faster than consumer sectors, agricultural stockpiling, OPEC plus supply management, in addition to, of course, the decline of the US dollar index. And the US dollar index and the US dollar provide the benchmark pricing for most global commodity markets, and thus maintain a direct impact on the cost of US priced commodities. The US dollar index, it remains 4% below its pre-COVID level at the end of 2019, which was 96.39. And as detailed in recent sensitivity analysis from our oil and gas explorer and producer, Rex International, and Fortress Minerals, our iron ore explorer and producer, the weakening of the US dollar can increase profit for commodity explorers, while the strengthening of the US dollar can have the opposite effect. So the price of crude oil is currently down around 5% from its July highs. Copper is down 12% from its April highs. Iron ore prices are down 40% from their July highs. Soybeans is down 12%. Crude palm oil is off 2%. Now, with these commodity prices coming off and remaining off their highs, this has been a main reason or a main a main reason or a main driver for the school of thought that says inflation is transitory from the supply side across the world. On the energy front, RH Petrogas, it did note in August that the OPEC plus production increases do tie in with the expectations of a demand-led recovery in the second half of this year. But at the same time, they contend with uncertainties which remain due to this ongoing spread of the COVID-19 Delta variant, as well as the possibility of sudden interest rate hikes. And they've also OPEC have also taken into account a possible increase in supply from a resumption of Iranian oil exports. So that's basically where the expectations are for OPEC. But nonetheless, RH Petrogas has added that despite the gains in the price of crude this year, markets are expected to see considerable volatility and uncertainty, because it is a very delicate act of rebalancing supply and demand amidst these decelerating sequential growth drivers, as well as the obviously ongoing COVID-19 developments. On the mining side, Fortress Minerals noted in July that it anticipates regional steel production will grow in tandem with economic and population growth, but it will be also underpinned by policymakers signaling their commitment to provide economic stimulus on an ongoing basis, particularly expansionary fiscal policy in the medium term, which in turn is expected to continue drive demand for infrastructure and iron ore. On the agricultural side, it's been interesting as well. On the 30th of August, Olam International reported its strongest operational earnings since inception. The CEO attributed the group's strong results for the first half of the year to the food security agenda, the rising protein consumption, emerging markets, food staples, demand, and of course, the fiber demand growth. And in addition to rising technology adoption and the sustainability focus within the agribusinesses. The CEO of First Resources also noted last month that looking ahead, palm's attractive relative pricing against competing edible oils is expected to lend support to prices, while the lower export levy in Indonesia will also help to reduce the export tax burden for exporters in the second half of the year. I should also note that on the agri front, Olam International, I just wanted to draw your attention to the fact that it presently ranks obviously ranks within the top 150 stocks by turnover, but at the moment it ranks just outside the top 50 stocks by trading turnover for the year to date, following its ranking as the 100th most traded stock last year. So based on current market values, effective the close on Friday, Olam International will be the top placed stock in the STI reserve list. So it will join the other four stocks in the reserve list, which is Suntec REIT, Keppel REIT, Fraser Centrepoint Trust, and Netlink NBN Trust. Now, this is an interesting slide. You might just want to take a second, check this one out. So among these, as we said, these 150 most traded stocks this year in Singapore that make up 95% of our day-to-day turnover, 22 of the stocks have seen more than a 10-fold increase in trading turnover in the year to date compared to 2020. So the trading turnover of these stocks in the year to date has grown more than 10-fold as compared to 2020. It includes 11 stocks listed on the main board and 11 stocks listed on Catalyst. The sectors that are most represented by the 22 stocks include the industrial sector, which has 6 stocks. 4 stocks represent consumer cyclicals, and then you've got energy, basic materials, and real estate making up quite a significant amount of shares with 3 stocks each. Now, the 22 stocks, they generated a median total return of 105% in the first half of this year, yet they've generated a median decline of 12% in the second half of this year through to the 14th of September. And that comparatively high return of the 22 stocks over the past 36 weeks or so saw the higher risk as well. The 22 stocks also generated a median 180-day historical volatility of 93%, averaging above 100%. Now, Del Monte Pacific is the largest of the 22 stocks by market value. Just last week, it reported for its quarter ending the 31st of July, which was the first quarter for its FY22, a year-on-year turnaround net profit of $18 million US. And that comes after the company ended its FY21 on a stronger note, reporting, I think, back on the 23rd of June, a turnaround net profit of around $63 million US. And that reversed an $81 million US dollar loss in FY20. So the group's second largest and most profitable subsidiary is Del Monte Philippines, which saw its international market sales for the July quarter rise something like 40% year on year. And that was on robust sales of the packaged fruit and beverages, which included includes the premium packaged pineapples that go to the US, and also the S&W packaged products in Asia. And for its outlook, the group maintained it is well positioned to build on the momentum achieved in FY21 and expects to be able to offset the impact of the commodity and the transportation headwinds, and barring unforeseen circumstances, does expect to generate higher net profit for its FY22. Of the 11 catalyst listed stocks in this table, this is the 22 stocks of the 150 stocks that have seen turnover surge more than tenfold this year compared to last year. The 11 catalyst stocks, the stock of the catalyst board with the highest market value, market capitalization, is Grand Venture Technology. That maintained, as you can see here, market value of 395 million Singapore dollars. So back on the 10th of August, Grand Venture Technology reported a 280% year-on-year surge in its first half net profit to $8.5 million. And it also declared a maiden dividend. The company has also recently completed a placement of new shares, which I think it completed this week, which will help fund the growth of its customer base and capacity scale of the company, which is a homegrown manufacturing solutions and services company. And furthermore, in line with its intention to undertake a transfer listing from the Catalyst Board, the Growth Board, to the main board, as it announced on the 1st of September, the placement will also allow the company to increase its share trading liquidity, its public float, and its shareholder count. So of these 22 stocks, OIO Holdings saw the greatest increase in trading turnover in the 2021 year to date from 2020, right at the top of the table. And that business, the core business of OIO Holdings, is blockchain technology services and mechanical and engineering services. So my final slide, looking at some of these drivers a little bit more, which we've talked about already in the presentation. I just wanted to draw them into some conclusion here. As we said, vaccine rates remain important, but as does the containing the spread of COVID-19 across the world. And hence the momentum of the 7-day rolling average of daily new global confirmed cases remains really important. We have seen some subsiding of the recent upward momentum of the daily global confirmed cases since the latter half of August. But as of now, that 7-day rolling average of the daily new global confirmed cases, it stands at around 600,000. It's down from 655,000 on the 20th of August. But the problem is this daily new global confirmed cases, it has not been below 350,000 since October last year. So there's investors, traders, you're all familiar with the concept of resistance and support and so forth. And there does seem to be that resistance level with those global cases coming down to and testing the 300,000 level a couple of times this year, but yet to break significantly below it. For Singapore growth, as we said, our GDP, it was up, I think 7.7% in the first half of this year. The advanced estimate for the third quarter, it's expected to be released by the second week of October. It's expected that GDP will grow 6 to 7% this year. So obviously, the growth is not expected to be as strong as it was in the first half. But look, on the back of that low base in the second quarter of this year, there were some upward surprises in hotels and restaurants, transport and storage, and the construction segments. However, there's obviously still elements of our services that have not made a full rebound yet, okay? And that will be watched closely. For instance, tourism is a major contributor to the economy, and with the significant decline of tourism, that's impacted shopping, accommodation, food and beverage, sightseeing, entertainment, the works. And like much of the globe though, manufacturing has been a key driver of growth, and the official SIPM PMI here, the SIPMM PMI, since June, it has continued to remain in expansion at a marginally higher pace. I think it came in at 50.9 in August, and that was after printing 51 in July, 51.0 in July, and 50.8 in June. The electronics sector has also edged higher from 50.6 at the end of June to 51.0 in August. And as we said, we've seen that extend to our technology stocks in terms of their comparative performance to the more broader manufacturing segments that is spanned by those industrials, consumers, and basic materials sectors. I think for the region, a really important point though is so much focus is on global trade, and the total value of trade between China and its partners in developing Asia, it has soared by close to 50% from $430 billion back in 2015 when we basically signed off on our ASEAN economic cooperation. So that's to developing Asia, and that's since grown to $640 billion in 2020. And over those years, the $200 billion growth in China's trade to developing Asia has more than offset the $50 billion decline in trade with the United States and China. And this has structurally poised developing Asia as the larger of the two trading partners with China, and the value of trade between China and its ASEAN partners from 2015 to 2020 has obviously also grown. And more importantly, I think over the recent years, the regional supply chains have been subjected to a lot of substantial restructuring. And this has been really influenced by the rise of the Asian consumer and the developments driving trade growth such as technology, communication, and e-commerce. So I think the IMF estimates that 2/3 of the world's industrial robots are used here in Asia, and the share of retail sales taking place online in Asia is 1.5 times larger than in Western Europe or the United States. Hence, two things, automation and e-commerce are playing a big key role in facilitating the channeling of China's high household savings to consumption-driven growth. A more consumer-driven region, it would be expected to see significant augmentation of service-orientated industries in Asia with new GDP growth, less led, I guess, by the exports of goods to the West. So the three key mega sectors that are typically associated with domestic demand, partly due to onshore regulations, ultimate consumer focus, and so forth, it includes finance-related services, business-related services, and the information and communication services. Innovation has also played a key role in China's growth. I think its yearly patent publications grew something like sixfold between 2010 and 2019. And clearly, tech regulation, particularly with e-commerce, is important for China when there is so much at stake, with e-commerce basically playing that ultimate pivot or that fulcrum role in the great rebalance from the high household savings into a more consumer-driven economy. Over to the US, I should say that the next FOMC is next week, Tuesday and Wednesday. And as we said, Jackson Hole has brought clear signaling that while tapering of asset purchases may begin before the end of 2021, the consideration of the Delta variant and its impact on the US labor market remains a priority ahead of interest rate hikes. Now, the Minneapolis Fed President Neil Kaspari stated a month ago that while the US has made progress, its labor market is still in a deep hole, and that 7 to 9 million Americans should be working now if the pandemic had never happened. So that's the state of play for the Fed Reserve. But I should mention that two of the drivers of, I guess, a lot of the liquidity in the market are kind of at their sunset level. The first is the money supply growth rate. Year on year, the money supply growth rate has normalized a lot since March. So year on year, there was a lot more liquidity in the market, which has generally started to slow per se. That excessive growth of money supply has been curbed, not just in the US, but globally, which means that basically the liquidity and the veracity of a lot of the moves and the rotations has begun to normalize somewhat. And then, of course, you have the tapering of assets possibly beginning as well. So I guess what that can mean for the market is that this year, the impact that week on week impact of both sequential economic growth accelerating, then decelerating, and then the ongoing concerns of the COVID-19 constraints across the world, they have basically been able to provide that traders type of market within our stock market, and with the ability to kind of rebalance and rotate and switch on these week-to-week developments. But those considerations will continue, obviously, going forward. The thing is, some of those proprietary liquidity measures of the global money supply and the stock market and so forth, they're expected to come off and drop a little bit as there's less money put to work across the world to support investment, and by extension, the stock market, commodity markets, and so forth. So, and also, of course, the microeconomic focus has been really important in Singapore. The strategic restructuring that we've seen across many of our companies, Jardine Matheson taking Jardine Strategic private, for instance. Capital Land Investment is set to begin trading on Monday, on the 20th. Capital Land will return as Capital Land Investment, and it will be the third largest real estate investment manager across the world, with Brookfield Asset Management and Blackstone Incorporated, the two biggest, both listed in New York, which means that Capital Land Investment will be the largest here in Asia. So I have tried to cover quite a lot tonight just to kind of give you the story on how and where the resilience has been in the Singapore economy, as well as our stock market, and what these companies have been saying. There's a lot to digest, but we can make it easier. And as I said, my job here at SGX really is as an educator per se. So I just wanted to note that we do have these reports available, Gary, that investors are more than happy to subscribe to if they wish to.
All right. Cool. Thank you, Geoff. Wow, a lot to take in. All right, I'm just going to share my screen now to let everyone know that we're going to do Q&As, yeah? Right, there's actually a lot of questions. I reckon you can see them as well, but for the benefit of our listeners, I'm just going to read them out. So yeah, lots to cover in Q&A, so let's get kicking on. All right, so the first one, since we're talking about stocks, and you've mentioned quite a few tonight, Geoff, one of the attendees, unfortunately he's anonymous, but he's asked, so he said he's been lucky enough to have caught a few of the explosive earnings stocks, and he's been divesting his portfolio due to unforeseen circumstances. As we all know, it's pandemic is a trying time. So he wants to know, that kind of bounced away. Hang on. Yeah, he wants to know, after the pandemic is over, how many of these stocks will continue to be resilient? So it's not just because of the pandemic that they actually are fundamentally strong and they'll continue to grow. Do you want to comment on that?
Exactly. It's like Shang Xiong, right? It had this massive rotation last year, but at the same time, the company is still looking to expand and set up in the HDBs, particularly where there's a lot of thoroughfare and so forth that have their own drivers. Technology as well. The interesting thing is it all depends on each company. For instance, the data centers, they will say that, look, the work from home demands put on excess demand for digitalization, which meant cloud services demand went through the roof, which meant the companies had these bumper earnings. But are we still headed in that direction in the medium to long term? It's you can have the demand is still there, albeit just less intense. So every stock will have its own story, and I think that's what you've really got to do. Look at each stock in terms of which companies have put measures in place to be able to sustain their earnings growth. You also got to look at the companies that were supported by, the Singapore government was tremendous in its support of the businesses, throughout this time. I think it was interesting that as we went into this last year in the mid-year, you had so many. The IMF were running a scorecard on all the countries across the world in terms of their fiscal stimulus. Basically, the average was around 10% thereabouts of GDP in terms of the amount of fiscal stimulus countries were putting into their economy. But Singapore was right at the top. They got to 20% very quickly. And as the IMF said this year, they have ample room to support, with fiscal stimulus being the main policy if need be. So you need to look into the earnings as well and see how much of the business has been supported by that, and how much obviously has the outlook in terms of their own growth.
Cool. Yeah. On that note, one of the stocks you mentioned earlier on, Q&M. So they've pivoted from being, dentists to now they've got laboratory testing. So yeah, what's the target price? Yeah, post bonus issue, given the stellar outlook from profit drivers, and obviously they've pivoted, right? What's the future like for those guys?
I'm gonna log into my. You want to ask me another question, and I'll log into my Bloomberg.
Cool. All right. Yeah. Target price. Yeah, no worries. There's one on STI and MSCI that's got a lot of interest tonight. So here's one. Yeah. How does the STI ETFs perform against the MSCI Singapore ETF? So ticker symbol EWS on the New York Stock Exchange, and why?
Yeah, MSCI. Generally they have been really highly correlated in the past, but going forward, they're less correlated because CADR is now in the MSCI Singapore. So that's been the ultimate changer. And the thing is, the weight of CADR has been gradually phased in. So now it's around 10%. When it started, it had only a 2%. It has 10%, and it will gradually increase should its market value remain pretty, where it is. But it is having a little bit of an impact. So we saw the STI outpace the MSCI Singapore somewhat last week because you had 3 days where you had CADR and our stocks, like our 4 big index stocks, which are the 3 banks and Singtel, pretty constant. But then on the Thursday and the Friday, the CADR declined a total of 8%, which basically when that moved the weightage of the CADR in the MSCI Singapore from that close to 12 down to 11%. So it dropped 1%. We saw some active traders basically buy the four stocks here, possibly selling the ADR as well, just to kind of follow that on a day-to-day basis. But yeah, it's a really good question, because I would encourage the investor. That's obviously a trader that's looking at that, and you can look at the mean reversions and so forth, and that's really interesting.
Okay, cool. So you mentioned the three banks, right? The big three. Now, with the impending interest rate hike, would we see a further hike in the STI?
Yeah, but I don't think there is a pending interest rate hike. I mean, the thing is, you remember the was it the June, or was it the July Fed Reserve meeting when the dot plot suggested that rate hike might come a little bit earlier than expected, and then Jerome Powell was very quick to say that that's not going to happen
Mm,
unless the economy is ready for it. And on the inflation front, we had the CPI come out earlier this week. It wasn't as bad as thought. It was expected to come in at 5% again. So it's not really. I don't think it's a pending interest rate hike. Jerome Powell, if he gets asked that question at the Fed Reserve, the press conference on Wednesday night, or let's say 2:30 a.m. Thursday morning, when that press
mm.
conference is on, he would be saying, look, that if there's a dot plot or some of those economic projections that it will release as well suggest that, he will say, look, like you said last time, all the individual dot plots, all the individual opinions coming out from the Fed members, it's just there to add transparency. It doesn't form a consensus. At the end of the day, the FOMC voting members have the final say, and they are very, very, very Main Street focused, more so than Wall Street.
All right. So let's just stay on the US now. So there's a question here. So the 10-year US Treasury, right? Do you think it will move higher from here? So the estimates about 1.2, 1.3%, and change the performance for the better. So again, Singapore banks towards the end of 2021. Do we see net inflow of institutional funds?
That's a tough one. I mean, the thing to look for the 10-year bonds is, if the 10-year yields go up,
Yep.
it's usually good for the banks and less good for the REITs. Okay.
Okay.
It's generally good for the banks, and that's on the back of the yield curve, mostly being driven by what happens in the 10-year bonds, more so than the 2 years on the short end. Okay, so it's just it's obviously that thinking is great, but like I said, I don't know. It just depends. It's just the good thing is you will know, because at the yield curve, the 10-year yields, they seem to be very, very focused on what's happening in the US in terms of its recovery. Okay, so obviously the US started not so well in January this year, but then recovered pretty quickly, and then things have kind of gone a little bit not so well in their fight against COVID. They also need the rest of the world to open up,
Cool.
because all their exports are services led and so forth. So you'll be able to read the economic signs.
Cool. All right. Do you want to come back to Q&A, mate?
Yeah,
Target price.
I've got it up. What I've got to do
All
is
right.
you got to let me share my screen, okay?
Okay. Yep. I'll do that. Hang on. Yep. Stop share. Yep. Off you go, mate.
Okay. Thank you. Yeah. There's my Zoom. Share the screen. Share screen 2. Take us off screen 2, and it should be there. Is it there? Can you see?
No, not yet.
What have Bloomberg done? Okay, let's try again.
Okay.
Share screen 2. Share.
Yeah, there we go.
Okay, great. There we are. So this is in Bloomberg. This is the ANR page, analyst research. Okay, so
Right.
Q&M Dental's here. Look at this man right at the top here, Mr. Kenatan. It says add target. So his target price is 89 cents, a little bit higher than the 12-month consensus target price, which is 83 cents. Okay.
All right.
And the last price is 58 cents. So you can click on Kenneth and see what else he's got going.
Yeah. There you go. So CGS-CIMB right at the top.
Yeah. Yeah.
Come talk to us.
Yeah, that's right. Okay, I'll stop.
Yeah. All right. Yeah, you'll stop, and I'll go back to mine. Yeah, bit of mucking around tonight. All right. Yeah. Okay. Let's switch gears back to Singapore. SPACs. That's back in the conversation. Temasek and GIC led. What's your take on that, Geoff?
Yeah, interesting because like you said, I've been in Singapore for 12 and a half years. I've been in SGX for 10 and a half years.
Yeah.
And I know that public consult with SPACs, it received the most feedback and interest of all the consultations that have been given to the market over the last 10 years.
Right.
So it took a little while, but I know Regco had to really review the feedback, and it really had to carefully engage the respondents, obviously the regulators and all the stakeholders. I guess what's important that we are a listing platform. We are meant to provide avenues for different companies to raise capital at all different stages of growth. So the evolution makes sense. SPACs is just one example of a way to do that. You know, we could be talking about other type of listing venues and whatnot in the years ahead. But our framework, it serves to, it's got to provide this alternative route, I guess, for the issuers.
Okay.
And the investors as well. But this is particularly going to be in the technology, industrial and health sectors. I think that's where a lot of the interest has been, particularly from the market participants when we released this. So yeah, it is pretty exciting. But you know, I think what's great is that our local media and the stakeholders, you know, that they're going to be watching this very carefully, and obviously, you know, pointing out the risks, making sure that all the investors realize that how these, you know, really educate the investors on how these different kind of platforms actually work.
Okay, yeah. So staying on the same topic of SPACs, Temasek, a lot of interest on Temasek in the Q&As tonight. So the latest 1 billion boost to the STI. Yeah, what do you make of that?
Yeah, I know. I mean, I've been following the Temasek announcements and so forth, and how they're boosting it. I think great. You know, I think you know, GIC won't invest in the STO because GIC has that mandate to invest in companies outside. But Temasek, I think it's a great core strength of our stock market. You know, basically having so many Temasek linked companies that are part of our market. I know for my colleagues that work in global sales and origination across the world, when they're pitching our stock market, and the investor relations people and the CEOs of these companies go overseas to pitch to institutional investors, there's a lot of credibility that you know that is helped when we talk about the Temasek linkage. So yeah, and boost and so forth. I mean, I don't know how or you know, how it's going to be executed and so forth, but it makes a lot of sense.
Oh, all right. Switching gears to another trending topic, Geoff, ESG. Now, what's your take on that, and any stocks that you recommend?
Yeah. So we're making a lot of progress, I guess, in this, as a lot of our companies are as well. Okay. So there's the Dow Jones Sustainability Index series that you can have a look at, and we've actually got some handful of Singapore stocks that are in that index. At the moment, the environmental focus on ESG obviously is the big one, given the urgency in the climate, in the you know, climate change and the warming planet and so forth. And then and that's why the scope 1, scope 2, scope 3 emissions have been laid out, which are pretty good. But I guess it makes sense. But the thing is that the thing where we've got to get to, the big next milestone, I think, is for these metrics, particularly the environmental, we're making a lot of progress, but for the social and the governance metrics as well, to reach some universal level of acceptance, you know, like the ratings agencies that have, you know, they look at a company's financials, they know exactly what to look at in the audited financial statements, and they say, okay, this is the standard, this is the international standard from which we rate, and we need to get there with the ESG, and I'm sure we'll get there soon because obviously there's so much attention, particularly coming from Europe, involved in this. But
Cool.
yeah, but and we've also got the scientific beta acquisition here at SGX, which is really interesting too. If someone would like to know a little bit more about ESG and the greenwashing effect and yeah, and how it's more about mitigating risk more so than seeking alpha. I've got a lot of some really great tech papers that more than happy to pass on.
Cool. All right. So yeah, it's getting late in the evening, so we'll take one last question. And just to wrap up, coming back to the topic of tonight's presentation, as we come out of COVID into an endemic phase, what's the future like? What do you think investors, traders should look out for given this new normal? Let's call it that.
Yeah. Just gosh, I mean, I think investing and trading is going to be a really important part of this. I mean, the thing is, there was a question before about our interest rates hikes coming.
Yep.
If inflation's under control, it's going to be a long time until we have really high interest rates, which means, investors and traders, we have to kind of to get it to make some money on the side, we're going to have to be doing our homework. I think the opportunities are there, the challenges are there, but the thing is that we've got a really vibrant market here in Singapore in the stock market. You wouldn't necessarily know that because it's not it's not necessarily the way it's branded in the public and so forth.
Yep.
But there is so much interesting aspects to our stock market. It is so diversified across these various sectors, across where all these revenues and assets are based across the world, that if you've got a view or there's part of the world or part of the economy that seems to be getting ahead more so than the others, there's a good chance you're going to find a stock or a product here on SGX that will give you some type of exposure to it.
Right.
So it's a really good question. The thing is, we'll always have to keep doing our homework, and I think trading and investing, it might even become a little bit more of a mainstream type of thing.
Yeah, as we're all stuck at home, or we're dying to get out now. Right. Yeah. So thanks for that, Geoff. Yeah, like I said, it's getting late. So for those of you who've asked questions and we weren't able to cover them, I think my colleagues put in the chat. You can write into us, and you've probably seen Geoff's QR codes as well. You can scan and you can ask SGX. Yeah, post this session. So yeah, I just want to bring your attention again. There is a competition going on right now. Stand to win Apple products every month. I think there's a new iPhone 13 that just came out, right, Geoff?
Yeah,
yesterday.
last night.
Yeah. And then Tesla Model 3 at the end of the year. So scan the QR code and start trading, investing, and join the competition. And if you haven't already, here are QR codes for our socials. You can just scan any one of them, and when you're on there, you'll be able to go into the others. So just leave that on screen for a while. And if you want to continue to learn about trading, investing, and hear from experts like Geoff, or talk to CGS-CIMB, scan the QR code, join our webinars. We'll get in touch with you. And that's it. Thank you, Geoff. That was wonderful. Thanks for your time tonight. Again, big thanks to Singapore Exchange, our partners in this drive to learn more about trading and investing, and to all our listeners tonight. Thank you for your time. I wish you a good Wednesday evening, and thanks, Geoff. I'll catch you soon.
Thanks, Gary. Thank you so much.
Cheers.
Good night. Thank you.